Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from Justin Huhn, founder and publisher of Uranium Insider, and one of the few newsletter writers really solely focused on the uranium sector and nuclear power, and all the different moving parts on the macro side and on the company side. And we'll put a link down below so you can follow along with Justin's work. Justin, it's always great getting you on the show, and we were remarking off mic. It's been a while, man. It's been since August since we've had you on the show. So it's great to get you on here at the end of the year for a recap of 2024. It's really been a wild and zany year in nuclear power, in the uranium sector, and I don't think we could have imagined more catalysts and tailwinds at the back of the longer term fundamentals here. When you think about what's happened in Kazakhstan, when you think about what's happened in Niger, Russia, US relations, big tech companies, there's so many moving parts. Maybe walk us through some of the key milestones or key news reports that came out this year that really are fundamentally important for the sector.
It's been an incredible year, Shad. It really has. And I would say that it's been a year of significant contrast as well between the fundamental drivers of the long-term story and the physical uranium price and the performance of the equities as well that has had its fits and starts. And we had some really solid runs in Q1. We had a really solid run in Q3 into early Q4. Now things have pulled back and cooled off here to end the year, and there's multiple reasons for that we can get into if you'd like, but the fundamental story just continues to grow, continues to grow. And I almost have to pinch myself. It's truly incredible that all of these elements have come to fruition that most of us could have never predicted or even wished for in our wildest dreams 4 or 5 years ago. To have Russia as the largest supplier of conversion enrichment be cut off from supplying the United States, the biggest market in the world, to have this bifurcation and the entire fuel cycle move up in price in the way that it has, to have the environmental left embrace nuclear as a clean and reliable baseload source of energy, and then to finally have the big tech companies in their race to achieve artificial general intelligence be building data centers just at an absolutely breakneck pace and pushing the grid to its limits, and finally now seeing them embrace nuclear as the long-term goal of being the provider for electricity for data centers for the decades to come. It's truly remarkable what has happened, and it's crazy. I was just talking to a buddy of mine yesterday, and we've been in this sector for many years. And Chad, I've been following this sector since 2017, and to have been following it for that long, and to look at some of these developments like big tech pushing data centers and AI and embracing nuclear, like this small modular reactor, advanced reactor, quote unquote, revolution that's happening. And to look at these drivers and say, I can't believe I'm saying this, but some of these themes, like I could actually be early on these things after being in this for 7 years. So it's remarkable what we're seeing. And in my opinion, what happened in 2024 was a foundation has been built that is underlying the growth of nuclear and the thesis for being long nuclear, long uranium. That foundation is there, and we believe that it's a fundamentally different market. At this point, the drivers are there. The growth story is clear for all to see. Now we get to sit back and let uranium have its day, which, even though we've seen the price rise from $18 to over $100 earlier this year to start off the year in January, now to pull back into the low 70s here for spot and the low 80s for term. Yet we've seen conversion enrichment go up like hockey sticks, and that's because the demand has really flooded into both of those services, both of those markets, and that has to come to uranium. That's what happens next.
Well, it's going to be exciting to see the push into uranium, probably beyond what people are expecting, to think a lot of the run is already over. I don't think we've even seen anywhere close to where this thing is going. But I want to touch on just a few fundamental things. Let's kick it off with Kazakhstan and Kazatomprom. What's your outlook on their production for this year and next year?
I think they're going to come in on the low side of the range that they forecasted for this year, which is, I believe, about 24 and a half thousand tons. It should be probably somewhere in the realm of 1,500 to 2,000 tons more than last year. Their production is going to incrementally increase as far as them being able to ramp quickly to that 30 and a half, 31 and a half thousand tons or 80 million pounds a year. That's just not going to happen. Much of the growth in the country is coming from a couple of joint venture projects, one of them in particular being the larger one, the Budanovskoye 6 and 7, which is the joint venture with Russia. That project has been significantly slower to get into full production. We'll see some production out of Budenovskoye this year, but we're not going to reach nameplate, probably not even next year. They need a lot more sulfuric acid. And like I said, while the country is able to incrementally increase production, I don't believe we're going to see a major windfall of supply that the industry that the utilities, I should say, would really hoping would come and come sooner. China continues to consume more and more of the future resources out of Kazakhstan. We've seen in the last 6 months one more very large contract on behalf of a Chinese utility. That was in addition to two other contracts of this similar size over the past 18 months. These contracts are so large that Kazatomprom has to have a special shareholder vote to approve because the value of the overall pounds under contract between Kazatomprom and this particular utility is greater than 50% of the book value of Kazatomprom. So that takes a special vote. Of course, it was approved. Then just recently, just last week, we heard that China was going to be purchasing from Rosatom two of their joint venture interests in Kazakhstan. Russia, of course, is looking to the future with Budenovskoye 6 and 7 and some other potential joint venture deposits that will be developed in the future, selling off some of these other projects. But China is just consuming uranium like crazy. Meanwhile, the Western utilities still seem to be focused on whether or not they're going to be getting their Russian deliveries in the US. The EU is covered a little bit better, but still, there's problems coming out of Niger that usually feeds, 5 million pounds to the French on an annual basis. So supply is problematic. It's not coming on as fast as the industry would like. And we think there's going to be a significant deficit for a few more years, even in the best case scenario for supply. We barely have a balanced market by the end of the decade, and that quickly changes as demand really comes in. With the 55 reactors under construction right now, 2/3 of those are going to be connected to the grid in the next 4 or 5 years. So demand is really going to shoot off to the upside. Supply is problematic. And Kazakhstan, they're going to remain the biggest player in the world. They have enormous resources they can continue to develop. But, as in most cases, the best deposits are drilled out and produced on first. You always high grade, basically, in any industry, you have high grading. And that's happening now. So we're seeing reduced production from their legacy deposits. We're seeing more sulfuric acid needed, higher price sulfuric acid. Just mining is hard, and supply coming out of the ground it's just not happening as fast as the industry would like. And that's obviously good for the uranium price.
Well, and we also saw, in addition to the shortfall in sulfuric acid for Kazakhstan and a lot of their production, there's also a new tax regime where it actually penalizes them the more they ramp up production. So I think that's keeping a lid on any expectations for runaway production out of the country. You brought up Niger and how there was the shortfall there that obviously impacted the French producer Orano. That was a big, significant, I think 4 to 5% of global supply coming offline as there was a coup in that government and still some uncertainty around it. You also mentioned the Russian. Well, it was kind of a two-part thing, Justin. The U.S. put sanctions, and so did some of the UN countries, on Russia and the supply of uranium coming out of the country, and issued waivers to some utility companies. But then Russia, in a tit-for-tat move, said, we're not going to export it. We're going to put an export ban to North America on much of this uranium. So that really soaked up even more potential enriched uranium and other fuel supply coming over to the West. You mentioned that China's been a big player, gobbling up a lot of the Kazatomprom production. But I noticed that China got their full allotment, and Cameco was about 18% short on their JV at Inkai. What do you make of the ability for North American utilities to source enough uranium with so many wild cards in the air about sourcing things overseas now?
Well, that's a big question, Shad, and it's a big question that the utilities in the United States have right now. And this isn't just impacting the United States, by the way. We saw the first impacts of the first shipment that should have had enriched uranium coming from Russia. This was about 3 or 4 weeks ago, and it did not. That shipment came across the Atlantic without the uranium on it. That was supposed to be a load for a Mexican utility that was going to have this enriched Russian uranium fabricated into fuel at Framatome in the United States and then shipped over to their reactor to be utilized in a core reload, in late Q1 of next year. And that's already been impacted. So this isn't just affecting US utilities. And this type of thing has very, very wide-reaching impacts and is one of the reasons why the year end is so quiet in the physical market because there's multiple utilities, not just in the US, but especially in the US, that are like, are we even going to get this next shipment? And maybe we won't. And what do we do about it? So they're still trying to figure that out. And uncertainty is the biggest driver of inaction in the physical market more than anything, more than price even. And price was a big one. We saw the price double last year into the early part of this year. And a lot of utilities stepped out of the market, said, okay, let's let this settle out. The term price kept climbing throughout the year. But now we have this actual physical impacting of the delivery of material that was binded by contract that is now essentially an active war with the U.S. cutting off Russia, but allowing waivers. Now Russia cutting off the U.S., basically an embargo. So it's a historical move. It really is. And I think that most people are underestimating the potential impacts of this. And of course, adding to the uncertainty is a new presidential administration with Donald Trump coming back in next month. And what is he going to do, if anything, about this situation? Will the delivery of Russian material come back on the table, at least in part on the embargo? As far as what Russia's action, will that be dropped? We don't know. The US utilities don't know. The global utilities that have material to be fabricated and fuel in the US from Russian EUP, they don't know. It's big uncertainties, and we're going to have to see how this settles out. But either way, it isn't a good thing for utilities. It isn't a good thing for the availability of products and services across the fuel cycle, and it's causing quite a mess. So we expect that starting in the new year, we're going to see more fallout in the fuel cycle pricing because of these first two. There's now a second shipment that has left the port of St. Petersburg without the enriched uranium it was supposed to have on it. So that's two shipments since this went into effect on behalf of Russia that have not left with enriched uranium on it headed to the United States. So we think we're going to see some reaction in the market. And the most important detail for this, if this ban continues, and supposedly it will until December 31 of next year, unless it's extended. Those are Russia's terms. So unless Russia starts granting waivers, or unless they drop this embargo as some sort of deal with ending the war in Ukraine, I don't know. This is all speculation, right? It's part of what's leading to this uncertainty. But if this stays intact and the US, in fact, does not receive any more enriched uranium from Russia for the next, 12 months and possibly longer, what happens is that any utility that had an enrichment contract with 10x from Russia that is not going to get that material, they are going to have to cover that off by buying spot enrichment at very high prices, and they're going to have to feed the uranium into those contracts. And that's going to create pressure in both the conversion, the UF6, and the U308 markets. Across the board, there's going to be pressure there. Of course, this is an exogenous event. This is sort of in addition to the overall supply and demand fundamentals, which are still intact. So we have roughly, according to our modeling, about a 35 million pound shortfall in supply this year. The only reason you can actually have that size of a shortfall for multiple years in a row is inventories. Inventories drawing down, producers being flexed up on from those legacy contracts with utilities. And right now we have producer inventories at basically decade lows. We have US utility inventories at right around a year and a half, which is very, very low for the US. EU is a little bit better covered, but China is buying up everything and supply has been problematic. Langer Heinrich from Paladin, their restart of that mine has been disappointing in terms of their production numbers. The coup in Niger has halted the production from Somer. The French mine's been producing there since basically the 70s. So nothing is coming out of that at the moment. And we've yet to hear if Cameco is going to ramp production in Canada. And Inkai, like you mentioned, their production is down year to date in Kazakhstan. So it's complicated. It's problematic on the supply side. The demand story gets better basically by the day. And we have yet to see the huge move in the price of uranium that we are expecting to see. And now this market is settling out at a higher low. It's going to find a bottom here at some point, probably pretty soon. And we expect the demand to come back in the new year and the price to respond. And equities are probably going to respond to that.
Well, and Justin, when you think about what you just laid out there as far as the shortage in Niger, the shortage in Kazatomprom, in Kazakhstan and the shortage from Russia and those boats leaving without the uranium in it, add the wrinkle on of, like you say, a new administration in the US where Trump has promised tariffs to Canada and Justin Trudeau countered with tariffs as well, including on uranium, which would be the supply from Cameco and if Denison ever gets into production, etc. So it really leaves US utilities, which are a huge chunk of the demand side of things, and there's a huge reactor fleet in the US with their hand out, wondering where they're going to get the uranium from. I guess that puts a focus and a spotlight on some of the handful, like about a half dozen U.S. producers that can actually at least start getting some uranium into utilities' hands. You think about the companies which are pretty much household names now, things like Energy Fuels, Encore Energy, Uranium Energy Corp, Peninsula Energy, Your Energy, and technically there are the U.S. assets that Cameco has that they could turn back on, but that's really it for production out of the U.S. But the U.S. has been one of the few places where we've actually seen production coming online that can actually be utilized by the utilities. So, what do you make of the environment for U.S. uranium production?
Very, very bullish U.S. uranium production. I think it's the jurisdiction for the next, probably for the end of the decade and potentially beyond. There's an enormous amount of momentum right now leading up to Donald Trump's inauguration with the, pro-America energy sovereignty. And I think that the U.S. uranium mining is going to be a big part of that. And all the companies that you mentioned, there's a handful of others that are explorers or early developers. ISO Energy is one that's going to be producing uranium likely next year in the United States, amongst the others that you mentioned. So not only the drivers that I just mentioned, we have the big data center built out and the tech companies that are based here. The nuclear reactors operating in the United States are unbelievably de-risked, and that's what makes this whole environment just so unique, is that you can argue that these interruptions coming from the embargo coming from Russia, the potential tariffs from Canada, whatever it might be, is going to lead to higher prices, and that's a problem for utilities. Well, these utilities, they cannot shut these things down now. The life extensions are going to happen across the board. We're seeing multiple reactors restart, and the electricity cost environment, in my opinion, is going to continue to rise, and that's going to be driven directly and indirectly by the purchasing of power by the tech companies to power these data centers. It's going to reveal the true value of electricity, and the utilities are going to be able to profit incredibly from producing electricity into this market. And these reactors you can't run these on anything else. You have to buy the uranium. And that is the last step or the first step in the fuel cycle, but it's the last priority in the fuel cycle. Once you have your conversion and enrichment, then you buy your uranium to feed into those services. So all of that is to say, I'm extremely bullish on U.S. miners and the future of U.S. uranium production. Also, don't even have to mention, but it's worth mentioning the strategic uranium reserve that's established and funded in the United States. It's going to be purchasing, a little over $1 billion. I think it's 1.3 billion, if I recall correctly, per year in domestically produced uranium to establish a reserve. And we also have the military demand that's a little bit more hard to model, but my understanding is that military inventories in the US are on the low side. And in the past, when they have been marginal buyers, they're price insensitive buyers and they're buying domestically produced uranium. So multiple reasons to be very, very bullish on the United States right now.
Well, just one more question on the US and then we'll pivot over to Canada. When you think about the demand that's coming and the need for domestic supply, do you think we'll see some M&A in the uranium space to take some of these smaller companies and mass them up into maybe one or two larger companies? Do you think some of those development and exploration assets that are out there, I can think of a half dozen to a dozen other US companies that have, known resources in the ground, do you think some of those get expedited and also get a premium as far as investors looking for opportunity?
Yeah, I think we're going to see more M&A and not just in the United States, just to speak generally. And one of the reasons for that is there's really only a very small handful of operators that are in this industry that have brought on mines in the past and know how to build mines. It's very, very few. I mean, you can count on maybe two hands how many people really know how to do this. It's a very small world, and it's a very, very difficult prospect to actually produce uranium. So I think we're going to see further consolidation. We've seen the fission uranium and Paladin deal. We've seen UEC pick up some projects, multiple projects. We've seen ISO Energy and Anfield which is in the final stages of approval on that. So we're going to see more of this, and I think consolidation M&A is actually very good for the sector, and I think that we will see more in the United States as well.
Well, and let's bring Canada in the equation because we already mentioned that Cameco has mostly Canadian assets in the Athabasca Basin, but they do have some ISR assets in the U.S. that are currently inactive. Anfield got some of the old Uranium One assets, as did UEC. But to your point, Anfield was acquired by ISO Energy, which is a Canadian developer with the Hurricane deposit. And then you saw UEC, a US based company, pick off UEX and get a whole basket of exploration properties in the Athabasca Basin, as well as the Rough Rider project from Rio Tinto. So there's a lot of cross border companies now that have both Canadian and US assets. How do things like the Canadian tariffs play into that? Do you think we'll see more US Canadian combinations? Maybe give us some insights on how you see things playing out across the border.
That's a little bit speculative still. I think that Trump is kind of playing hardball and Trudeau is doing his best to play back. I have a feeling that Canada and the United States will be fundamentally working together going forward. So it's hard to say if there will be tariffs imposed or not, but most likely we'll continue to see further, combinations between the companies operating in both jurisdictions. And I think, going out mid to long term, that we should see the countries continue to work together as they have, especially in this industry over, its entire history.
Well, and let's talk. The only producer currently in Canada is Cameco. So people talk about where's the production going to come from. There are some development projects like the Wheeler River and Phoenix project that Denison has, or possibly you'll see something where Paladin moves the fission project forward. But right now, it's just Cameco. What's your outlook on Cameco as far as what kind of production output can they have from their Canadian projects? And then we've already mentioned the shortfall out of Kazatomprom by about 17%. But looking forward, are they going to be able to come anywhere close to producing enough to even help North American utilities?
Yeah, I think so. And, in addition to Cameco, although they aren't publicly traded, we also have Orano producing. So Orano is their joint venture partner at both MacArthur and Cigar, but Orano is also producing a much smaller amount of uranium, but they are doing so independently from their McLean Lake deposit at the McLean Lake mill that's owned by Orano and Denison. And this deposit is being mined with Sabre technology, which is the surface access borehole recovery. This is a newer technology that's been developed for the last decade or so, and Orano has proven this is viable. And so I believe that there's multiple high grade deposits that are shallow enough in the Athabasca that are ripe for development. And considering that Orano is basically closing the door on Niger or having the door shut on them by Niger is probably a more accurate statement. They're going to be looking for further production elsewhere. They've got a ton of legacy contracts. They're a major player in the global nuclear fuels market. I would not be surprised to see Orano. They're also state owned, right, in France. So I wouldn't be surprised to see them take something or somebody out or a further joint venture, perhaps with somebody else in the Athabasca to produce more from that Sabre process. As far as Cameco goes, they can technically ramp up MacArthur River to 25 million pounds a year. That's the nameplate license capacity. And currently they're producing 18 million pounds. We'll see if they get a little bit more out of that this year, but they haven't officially stated if they're going to ramp or not. We believe that they will. Their assets in the United States are pretty good, but their tier one assets, obviously MacArthur and Cigar. MacArthur's a monster. So they should be able to ramp that up, but that is going to take time and it's going to take a lot of money. It's a much more complicated process than anybody understands. It's not just flipping a switch or turning a knob to take it to 18 to 19 to 20 to 21. It's incrementally more difficult and complicated to run that larger amount of throughput through the mill. So they'll be able to do it, but they're not going to do it unless and until they have much more and higher price contracts signed with utilities to support that expansion. And my understanding is they are holding the line in the term market along with the other producers, despite the fact that spot has fallen back down here into the low 70s. Term remains firm at 82, 83, and the producers are holding that line. And one big piece of evidence of that is the recent contracts from NextGen. I mean, sorry to go off on a tangent here, but I think it's relevant. NextGen, which has yet to put a shovel in the ground, signed contracts with multiple large US utilities for 5 million pounds delivery starting in 2029. 100% reference to the market at the time of delivery. Floors at $79 a pound, ceilings at $150. So NextGen is saying we're not going to be producing for anything less than this. These are the ceilings we're willing to offer. This is basically a testament to where both the buyers and the sellers believe the price is going because that ceiling protects the buyer from paying more than $150 a pound at the time of delivery starting in 2029. By the way, which is also an escalated price based on rates and inflation. So by the time you get to 2033, which is the last year of delivery under these contracts, you're looking at 180-ish with the escalators. So huge signal to the market, these contracts that NextGen signed. And I think that points the way for the price of uranium going forward. But yeah, Canada going to continue to be a big producer. Don't know what's going to happen with the tariffs. Cameco can ramp. It's going to take tens of millions of dollars in multiple years to go from 18 up to 25, but I think eventually it does happen. Orano, they've got to be sniffing around here at this point.
Well, and I'm glad you brought up that contract that NextGen signed because, yeah, ceiling of 150 and then the escalators up to 180 just goes to show where fuel companies and uranium companies think the pricing could go in a more bullish scenario, which we've yet to see those prices for a long time. I think the last time we saw a peak was at 140, but if they're putting in ceilings above that, I think that is a very interesting signal. It's interesting you bring up NextGen, Justin, because a lot of people thought, and there's been some vocal pundits in the marketplace saying that Fission's Triple R project and the Patterson Lake and NextGen's Arrow deposit should have been developed in tandem because of the shared infrastructure benefits of roads and infrastructure and power that would come into that area. Now that Paladin bought Fission and NextGen, as you say, hasn't even put a shovel in the ground yet, they're signing these contracts. How do you see those two projects moving forward? Can they move forward separately or do they need to move forward together?
Well, I don't think that they need to move forward together. And I think that if they needed to, you would have seen some sort of collaboration earlier. But it's possible with the changing of the guard and now that Paladin's management is there, that something can be worked out with NextGen's management. I'm not really sure. NextGen has been forging ahead seemingly without any interest whatsoever in doing so tangentially to Fission. Fission, their deposit is much shallower, but it's also under a lake, so it's a little bit more complicated, but not beyond what's doable. But clearly, the development of that deposit, which was discovered in similar timeframes to NextGen's Arrow, has been essentially left in the dust by NextGen. I mean, is a stone's throw away from actually having their permits and getting this mine in development, which I think once they have their permits and have a clear path towards developing this mine, I think they're potentially a target to a large multinational mining corporation. And we've heard some anecdotal stuff over the last month. The CEO of Exxon actually saying that they're looking at the nuclear industry. The oil companies used to operate some of these uranium mines and enrichment facilities and things like that, fuel fabrication way back in the day in the 70s and 80s. And it wouldn't be shocking to me to see some of these big multinational mining companies or oil companies even step in the chain at some point, right? So multiple drivers here that they're going to make these deposits that are near development very attractive to anybody who's paying close attention to the numbers. And NextGen is going to need what, $1.5 to $2 billion to build this mine, and they're going to pay it back in less than a year, according to their feasibility study. But it's also proposed to be the largest mine ever built for uranium at 28, 29 million pounds per year in the first 5 years. So they've got an enormous task ahead of them. This is a deep mine. It doesn't have the water intrusion problems at Cigar and MacArthur's, but it is, 6, 7, 800 meters deep and a mill that can produce 28, 29 million pounds of yellow cake. That's no small feat to build that, plus the infrastructure there. So whether or not these two companies have some sort of combination in the future, I don't really know. It's hard to say, but thus far, there hasn't been any evidence coming from NextGen or from Fission for that matter that combination is likely and is imminent. It's mainly just been shareholders, mainly Fission shareholders saying, "Hey guys, what about us?" Uh, and so far, NextGen is like, who are you? We're just going to keep doing our thing." But perhaps this changing in the guard, I think it's a good thing. I think that Paladin's management has done a fairly good job of getting Langer Heinrich back into production, and it'll be interesting to see what they can do with PLS.
Yeah, it's been an interesting saga to watch it all play out over the years between Fission and NextGen shareholders and an interest in working together, but then maybe some management egos getting in the way for part of that time period. But it's interesting now that Paladin is in the mix. And again, the point being, Justin, that even if Fission and Next Gen Zero get built, they're still years away from actually being in production. So that doesn't help us in 2025, 2026, 2027. These things are still 2028 or 2029 projects for the most part. So that doesn't leave us with a lot of production coming out of Canada. Let's talk exploration and development, though. There is a lot of money being spent in the Athabasca Basin, and to a lesser extent, even in the Thelon Basin. But in the Athabasca Basin, despite all the money raised over the last 2 years and all the drill programs, we haven't seen a lot of new discoveries. Now, we did see a little bit with Canalaska this year. That's probably one of the standouts. F3 had a big one last year. Obviously, ISO Energy with the hurricane the year before that. But we really haven't seen a ton of new discoveries, and there were about a dozen or 2 dozen new companies that came onto the scene over the last couple of years that raised money, went out and drilled, just highlighting the point that it's really hard to make these discoveries at the unconformity with the high grade uranium that don't have issues or challenges. And we've had a little bit of smoke, but not a lot of fire. What do you make of the overall lay of the land and the exploration and development scene in the Athabasca Basin?
It hasn't really hit a mania phase whatsoever during this bull market. We haven't seen an enormous amount of drill rigs out plugging holes in the ground. We haven't seen a huge amount of money flow into the explorers, and it's hard to really say. I mean, I think that the kind of the decline of the TSXV, generally speaking, over the number of years, hasn't helped. I think that the mining companies, especially the exploration companies, especially when they're so small that they're not held in the ETFs and don't get the benefit from the general flows into the sector, are just dilutive machines. And it's a very, very tough game because, if you've got a $5 million, $10 million market cap and you got to do a $2 million drill program, which is not necessarily a very big drill program, and you come up and you get dusters from all of your drill holes, that's pure dilution, right? I mean, it's a tough, tough, tough game. And so far in this market, the flows have gone into the big caps and the ETFs. And the ETFs have moved, anything that is big enough to be held by the ETFs. And URNJ is buying up and holding some smaller companies, but still the tiny cap explorers they're just kind of scraping along the bottom, hoping for the best and hoping for a stroke of luck. And it's very, very difficult. But I also personally think if we look out at the demand picture for nuclear that is being projected, or let's say being opined by the IAEA, by the COP conferences, the countries signing the triple nuclear initiatives, the net zero goals that include doubling or tripling nuclear, we need a hell of a lot more exploration and development and fuel cycle development, conversion and enrichment and fabrication, all of that. But that's all still at this point, besides China, kind of wishful thinking. And between now and then, we've got a handful of brownfield projects. We've got a couple of high-grade, larger greenfield projects like Arrow, like Phoenix, like DASA, that if these projects do get off the ground, like I said, we're going to have a balanced market for a brief moment in time. But beyond that, in my opinion, I believe that there's been enough discoveries made that with a $150 uranium price that's stable, we're going to see these projects eventually developed and we're going to have enough coming out of the ground unless and until we see these huge, huge stated goals actually come together. If we see the United States building a half dozen or a dozen new AP1000s, if we see that type of move in nuclear where the countries that are pledging in triple nuclear actually get their act together and start to make it happen, then we're going to need another wave of exploration and development. But in my opinion, based on what's under construction now and is what is operating and expected to life extend, the already discovered deposits, if they get developed in the next 10 to 15 years, is going to get us over the line on the supply side, but not by much. So I don't think we need a hell of a lot more exploration. I think we need much higher uranium prices and sustained in order to put the already discovered deposits into production. When we see the really big growth of nuclear happen, when we see dozens and dozens and dozens of SMRs being built concurrently globally, and like I said, new large reactors being built in the West, then it's time to start drilling and find some more uranium in the ground because what we have already discovered that hasn't been developed yet is pretty enormous. It's just going to take time and price initiative to make those deposits mineable.
Well, you bring up a great point. There's already been so much uranium found, not just in Canada, but in the US as well. what's the incentive price that you have in your mind that you think it needs to get to and stay there to really start causing larger companies to come in, maybe the oil and gas companies or some of the larger multi-asset production companies to come in and start developing some of these projects? Is there a price you have in mind that it needs to be at or stay at?
Yeah, I think ideally the incentive price to really get the industry moving on the development side of things is going to be north of $100 a pound. And it's not just the spot price, it's the term price getting above that level. The term price here is 82, 83. It's going to get there. I wouldn't be surprised if it got there next year, but it's going to need to get there and it's going to need to stay there for a while. And it's just the price being at a certain point is not going to get, let's say Bannerman's Etango or some of the other higher cost projects in the United States. These projects are not just going to go through the risk of raising capital and the risk of developing these mines just because the price on a specific day is at a certain point. They're going to have to sign some contracts and they're going to have confidence in the continued trajectory of the price of uranium. And if the price stays where it is here for 82 bucks a pound right now and spot in the low 70s, whatever's under development now is going to be developed, and anything beyond that is going to be DOA. So you're going to see NextGen continue forward because they're profitable. You're going to see Denison continue forward. You're going to see Global Atomic, if they can make it happen and get funded, move forward with DASA. But besides that, there's plenty of other early stage development or explorer projects that are just not going to go anywhere at this price. And so I think we need to see north of $100 spot and term, and it's going to need to stay there a while. And that's just the incentive price, Shad. That's not necessarily the price of uranium per pound in the spot market based on, the buyer of last resort. And so if we see a moment in time, which I believe we will, where multiple buyers are trying to procure limited pounds from a single seller or a couple of sellers, and they're going to pay what they have to pay in order to procure that uranium. And I think that's the bridge we're going to cross. I don't know if that happens next year, but in the next few years, we're going to see that happen. And incentive price is going to be basically irrelevant. It's going to be whatever they're willing to pay. And like I said, that contract from NextGen that was announced is pointing the way. $150 ceilings, that's not an accident.
Well, Justin, just as we wrap up, for people listening in, if they wanted to get exposure to the uranium sector, there's always the ETFs like URNM, which includes the Sprott Physical Uranium Trust inside of it as an asset, or they could just buy the Sprott Physical Uranium Trust for exposure to uranium. You mentioned URNJ, which is the smaller junior Sprott ETF. But for everybody else that wants to do some stock picking, maybe just spend a minute and just share what you offer subscribers to your service. In addition to all the macro news on nuclear power and uranium fundamentals, you also get into your portfolio. Can you just remind us how things have gone in the portfolio this year and then what kind of service you give to subscribers of Uranium Insider?
Sure. And I should say, even before telling you and our audience about what we offer at Uranium Insider, this moment in time is extremely unique and I think a very, very compelling value proposition because the equities have gone on a slide over the last 3 weeks as the uranium price has dropped a bit. And the uranium price dropping here to the low 70s is on a couple 100,000 pounds traded. I mean, it's nothing. Like, and the fuel buyers are on vacation. We're recording this 2 days before Christmas. Like, nobody is buying here right now. So there's a couple of sellers with a couple 100,000 pounds they're trying to offload, and that's causing the price to drop in an absolutely dead market. So don't look at the price and think this is what happens. There's too much supply. That's absolutely not the case. All of the uncertainties I mentioned earlier in our conversation, Chad, with the incoming administration, with the Russian embargo, what is going to happen with the Inflation Reduction Act, et cetera, that is causing a temporary moment in time, quiet market. And in a quiet market, any supply is going to cause the price to drop temporarily. So that's where we're at right now. The equities have pulled back. As we record this, most of the equities in the uranium space are, somewhere between 30 and 35 RSI, pretty oversold. Considering the mid and long-term demand drivers for nuclear and where we believe the price is headed, I think this is an enormous opportunity for anybody wanting to build positions here or add to positions here, which is what I am personally doing. So with all of that said, Uranium Insider, I haven't crunched the numbers for December yet, but since inception, August of 2019, we're up about 400% in our overall portfolio compared to URA, including dividends at maybe about 230%, something in that ballpark. So we've had significant alpha. We have a small team dedicated to the nuclear and uranium space, and this is what we do every day. We put a lot of focus into the physical market. We want to know who's buying, who's selling, and what the trajectory is of the physical price, because that ultimately is what matters more than anything in this trade. So having a grasp on that and communicating that to our members is very high importance for us. We also have members only webinars we do once a month. We bring industry executives and industry veterans on to discuss this market with us and with our members. These are usually 2 hours long and very in depth. And yeah, we've been doing this for the last 5 years, 5.5 years at this point almost. And it's been quite the labor of love. It's amazing. Like I said, I can't believe I'm actually saying this, but considering the big tech drivers and the small modular reactor revolution, like we actually might be early. And some of this, the uranium price has moved up significantly from the lows in 2016. The equities, generally speaking, if you've chosen well, have done very well since that period of time as well, especially since the COVID lows. And some of them haven't, but many of them have. We think we're still in the early innings. We still have not seen the big event for this trade, which is multiple years of replacement rate contracting volumes being traded. So this year, still, as of today, 100 million pounds have been done in the long-term contracting market during a year where utilities globally consumed about 190 million pounds. So we have a long ways to go to get to replacement rate, and there's just insufficient inventories at this stage for utilities to draw them down much further and stay out of the market. They have to come back into the contracting market. We expect that to start to happen again in 2025, and it should last for multiple years. It's going to be a major driver of the price. And as you know, generally speaking, the mining stocks tend to follow price. They've underperformed the price of uranium over the past couple of years, but the first leg of this market, which was December 2020 through about November 2021, was a massive, massive run for miners relative to the metal. And we think we're setting up for another one of those, and that could be 2025 in the making.
All right. Well, let's wrap it up there. Let's hope that we start seeing some of the outperformance in the mining stocks over the underlying commodity. Be nice to see that again, like we did in 2020 through 2021. And a lot of opportunities. I guess you're spoiled with choice in the uranium equities right now because the sector has been through a corrective move. But with so many tailwinds behind nuclear power and the uranium price fundamentals and the contracting cycle about to kick off again in 2025, could be an interesting time for investors to do their homework and dig into the sector. And if you want to get more information on Justin's service, Uranium Insider, definitely click on the link below this interview. It takes you right over to his site where you can sign up and hear straight from Justin every day, every week, what he's looking at in the markets and which companies have his attention. Justin, great to do this end of the year wrap up with you on the whole sector and looking forward to talking again in 2025.
Been my pleasure, Shad. Always great to speak with you, and have a wonderful holiday.